Welcome to TrustPoint's second webinar during these challenging times dealing with COVID-19. I'm Mark Chamberlain, Senior Vice President at TrustPoint. We are doing everything we can to stay in touch with our clients. We are operating normally. Thank you for doing business with us. Today we are going to start with an overview of the CARES Act from Brenda, and then Randy and Jan will present a market update. I'll turn it over to Brenda.
Thank you, Mark, and thanks to all of you that joined us today. During the next portion of the presentation, we will cover the high points of the CARES Act. Our focus will be on the impact to individuals in regard to recovery rebate checks, tax implications, and retirement plan and IRA updates. Congress has recently passed 3 bills to help mitigate the financial impact of the coronavirus, including the most recent, the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, which was signed by President Trump on March 27 and has an estimated value of more than $2.2 trillion. The relief is directed at many entities and programs, as noted on the slide, but as stated previously, this presentation will focus on individuals. We will be covering the high points of the Act as we know it today, but the government will be providing further guidance in coming weeks. First, we will look at direct payments to individuals, referred to as recovery rebate checks. The one-time cash payment will be $1,200 to individuals and $2,400 to married couples filing jointly. The amount of payment phases out at various income thresholds. For singles, phase out begins at adjusted gross income, or AGI, of $75,000 and is completely phased out if AGI exceeds $99,000. The AGI phase out amounts for married filing jointly is $150,000 to $198,000, and for head of household with one child, $112,500 to $146,000. The payment is reduced by $5 for every $100 of income that exceeds the threshold and phases out completely at the top level of the threshold. Individuals are eligible to receive an additional $500 for each dependent child under the age of 17. There are no limits to the number of dependent children for rebate purposes, and the definition of a dependent follows the IRS guideline that you must provide 1/2 of the support and the child must live with you for 1/2 of the year. The AGI threshold is increased by $10,000 for each qualified child for all filing statuses. For example, if single and 2 qualifying children, the AGI threshold starts at $95,000 and phases out at $119,000. If head of household with 2 qualifying children, the start of the threshold is increased to $122,500 and reaches complete phase out at $156,000. The adjusted gross income is based on your 2019 tax return, if already filed. More to come on updates to filing deadlines later in the presentation. If the 2019 return has not been filed, it is based on your filed 2018 tax return. If an individual is not required to file a tax return because their income is under the filing threshold, their income for rebate check purposes is based on their 2019 Form SSA 1099, which notes Social Security benefits received. One caution, there are already scams in place attempting to take advantage of uncertainty regarding these payments. Please do not be fooled. The vast majority of individuals will receive these payments without taking any action. No government entity will request your bank account information over the phone. The IRS will deposit the rebate in your bank account if you have provided the routing information and account number on your 2018 or 2019 tax return. If that information was not provided, you will receive a check in the mail. Next, we will look at individual tax updates under the CARES Act. The deadline for filing and payment of individual 2019 federal income taxes has been moved from April 15th to July 15th, 2020. Many states, including Wisconsin and Minnesota, have extended their payment and filing deadlines to coordinate their due dates with the new federal due dates. However, in many states, estimate payments are still required prior to July 15th. Wisconsin has extended the 2020 Q1 estimate due date to July 15th, 2020. As of today, Minnesota has not. However, updates seem to be occurring daily, so please continue to monitor as we near the April 15th deadline, and also consult with your tax professional for guidance regarding your circumstances. The CARES Act provides new tax incentives for cash contributions made to public charities. Taxpayers who take the standard deduction, which is approximately 90% of all taxpayers, will be allowed up to a $300 above the line deduction for cash contributions made. The CARES Act also suspends the 2020 AGI limitation for qualifying cash charitable deductions. As a result, taxpayers who do itemize will be able to deduct total cash contributions made up to 100% of their AGI rather than 60%. The Act does not specify that such cash contributions be made for COVID-19 relief efforts. To take advantage of the higher AGI threshold, the taxpayer must make an active election on their return. Please note that non-cash contributions and contributions to private charities, supporting organizations, and donor-advised funds are not eligible for either of the enhanced charitable deductions. Moving on to the CARES Act impact on retirement provisions. Required minimum distributions, RMDs, for 2020 are suspended for most defined contribution plans and IRAs. This includes distributions that would have been required by April 1st, 2020 due to the account owner deferring their initial RMD after attaining age 70 and a half in 2019. Suspension of these RMDs allows account holders to delay withdrawals of investments that may have fallen in value. If the money is not needed now, you can delay withdrawals until after your investments have had an opportunity to recover. Although RMDs have been suspended, the Qualified Charitable Distribution, or QCD, is still in place. The QCD allows an IRA holder, age 70 and a half or older, to make a distribution to qualified charities in total of up to $100,000 per year. The distribution is not included in your taxable income, nor may the distribution be used as an itemized deduction. Qualified charities for QCD purposes do not include private foundations, donor-advised funds, or supporting organizations. The CARES Act also contains provisions for special withdrawal opportunities for individuals financially impacted by the coronavirus. To be eligible, the individual must meet one of three criteria. 1, been diagnosed with COVID-19 by a CDC-approved test. 2, have a spouse or dependent diagnosed. Or 3, experienced adverse financial consequences as a result of the virus. Adverse financial consequences are further defined as a result of the virus causing an individual to be quarantined, furloughed, laid off, or having work hours reduced, unable to work due to lack of childcare, or a business owner who incurred reduced hours to the business or had to close the business. During 2020, if an individual fits these criteria, they are eligible for hardship withdrawals of up to $100,000 from their retirement plans or IRAs. Such withdrawals will not be subject to the usual 10% early withdrawal penalty if the individual is under age 59 and a half. The withdrawals will still be treated as taxable income. However, the income tax on the distributions may be spread evenly over 3 years, with the first tax year being 2020. Alternatively, the tax can be avoided entirely if the distribution is repaid to the retirement plan within a 3-year period. The repaid amount is considered a rollover. We expect future guidance on tracking and tax reporting of partial repayment or repayment in installments during the 3-year period. Stay tuned. Rules surrounding 401k loans have also been extended for a 180-day period beginning on the date of enactment. Affected individuals can also receive loans from retirement plans up to the lesser of $100,000 or the present value of their vested benefits. Prior, loans were limited to 1/2 of the vested balance. In addition, loan repayments for affected participants may be delayed for 1 year. Please note that your employer-sponsored retirement plans must be amended to incorporate these new loan provisions rules before you can take advantage of them. Please contact your plan sponsor if you have questions about your plan. Lastly, the CARES Act also expands unemployment benefits. The Act will add $600 per week to state unemployment benefits for up to 4 months. Self-employed workers, independent contractors, and those who typically don't qualify for unemployment benefits will be eligible. The federal program will be in place from January 27th, 2020 through December 31st, 2020. The extra $600 weekly benefit, however, will stop at the end of July. Individuals must apply for unemployment benefits with the respective state in which they work. State departments of labor will administer the expanded benefits as well as their existing benefit programs. If qualified by their state and already receiving state benefits, an individual should automatically receive the additional federal benefit under the CARES Act. The same holds true if applying based on current conditions. Once qualified at the state level, an individual should receive the additional federal benefit. There most likely will be delays in receipt of the additional benefits as the states work through the new rules and incorporate them into their processing systems. This concludes the CARES Act update portion of the presentation. As with most things at TrustPoint, this presentation was a team effort. I'd like to extend a thank you to my colleagues, Blake Barnes and Dustin Cunningham, for their help. Thank you for attending, and thank you to those who submitted questions in advance. We have included responses to those questions in the materials covered. If there are further questions, know we are here and available by phone and email. Please reach out to Relationship Manager or other TrustPoint professional contact. Thank you. Now I'll turn it over to Randy and Jan.
Thank you, Brenda, for that explanation of the recently implemented CARES Act. As we move into the market update portion of today's webinar, Jan and I have crafted a few questions for each other. So I'm going to jump right in and start by asking Jan a straightforward question that probably is on everybody's mind. Jan, can you give us an update? What is the situation with the COVID-19 today?
Sure. So globally, we now have over 1 million reported cases, which is about double what we had just last Friday. In the US alone, we have over 250,000 reported cases, which is about 3 times what we had just last Friday, and also 3 times the number of cases China had at its peak. These are big, scary numbers, but they should also not be a surprise to anyone. As the virus has continued to spread and testing is more widely available, more cases are simply being reported. On the next slide, we have some good news to share. The good news is that social distancing measures are starting to yield some results. As you look at the chart here, and you look at Italy in particular, the number of reported cases in Italy has peaked. And across the rest of Europe, we're also seeing early signs that some countries are starting to see a slowdown in the number of new daily cases. So it wouldn't surprise us to see a peak in the number of new daily cases sometime in late April in both the US and globally. Now, it'll be a battle. There's no doubt about it. But the actions taken to mitigate the problem are starting to yield some results here. It's also encouraging to see that Washington has been more realistic as of late about the magnitude of the problem and the things that we need to do to tackle it. Now, if you remember just last week, President Trump was still discussing the idea of reopening the economy by Easter. This past Sunday, he instead announced an extension of the distancing measures to the end of April. So we certainly believe that was the right thing to do because we know, based on past experiences around the globe, that only aggressive and sustained actions will not only save lives, but will allow our economy to return to some sort of normalcy earlier. As we discussed last week during our webinar, federal guidelines are helpful, but at the end of the day, we know that state governors have the last say. So from 20 states last week, we now have over 2/3 of US states under strict restrictions. And those would be the ones in yellow on the chart here. So now the majority of states have now adopted stay-at-home policies and asked non-essential businesses to be closed. The reality, however, is that all of us are still free to travel anywhere we want domestically. And from that perspective, aggressive preventive measures taken by one state can quickly be undermined by more relaxed rules taken by others. And that for us remains a little bit of a concern. But thankfully, I think most people understand now that it's better not to travel, period, because at the end of the day, we all know that we have to do, all of us, our part here to make this work.
Thanks, Jan. What about the markets? How have the markets responded to all of this in recent days?
Yeah, so if you go on the next slide, now equity markets are up 10% from the lows reached on March 23rd. So we're still down about 25% from the peak reached in February, but we have certainly seen a nice bounce here in the last 10 days. We know that large bounces are common during bear markets. And I think that's a topic, Randy, you'll address in a second here, the importance really of staying invested and being patient during downturns. But I can also report that now we're pleased to see that markets are operating normally for the most part, and volatility has subsided as well, which may indicate that investors are starting to get a little more comfortable with what the future may look like. Now, we all know it's still a very uncertain environment, but you get the feeling that slowly but surely, we are starting to get a handle on the situation we're in here.
Jan, one of the most significant ramifications from all the social distancing efforts is job loss. The unemployment claims report yesterday confirmed that in the past 2 weeks, about 6.5% of employed persons in the United States have filed for unemployment insurance claim. Can the market continue to rally in the face of bad economic news?
Yeah, that's a good question. Now, we all know that the economic data for the coming weeks and months will not be good. Now, the US and the world economy are on a respirator in the IC unit right now. We all know that. But markets will not wait for the patient to be fully recovered before rallying. And I think that's very important to understand. Markets typically try to anticipate economic activity 3 to 6 months in advance. So markets are likely to form a permanent bottom here before economic reports get better. And what has helped markets as of late is really the support provided by central banks and governments around the world. Authorities around the world are currently showering cash like never before to limit the damage caused by COVID-19. If you look at this slide here, in the US alone, the Federal Reserve has been really aggressive and early as well in cutting short-term interest rates to zero. Now, it took the Fed many months during the 08-09 crisis to get to the zero bound, but not this time around. And in addition to cutting short-term interest rates, on the next slide, you'll see that the Federal Reserve has also launched a number of programs that some were created during the 08-09 financial crisis, but they've also created new ones as well to help liquidity and help markets function properly. So that is the monetary side of things. If you look at the next slide, on the fiscal side of things, we know that the CARES Act will provide a lot of stimulus as well, over $2 trillion worth of stimulus. And as you may have heard from Washington in recent days, discussions have already started for another round of stimulus if needed. So the actions taken by the authorities globally now have, in our opinion, so far been proactive, large, and open-ended. And that's very important for markets, this idea of an open-ended commitment, the idea that if more stimulus is needed, it will be provided. Because I think at the end of the day, we would all agree that nobody wants to see the US or the world economy for that matter die in the IC unit because of COVID-19. So on that, Randy, I would like to turn it over to you now and ask you a question. Well, like many of us at TrustPoint, you've had an opportunity to talk to many of our clients recently. What stands out to you the most about these conversations, and what are people thinking about the situation, and what are they doing about it?
Yeah, thanks, Jan. Yes, I want to take a moment to talk about the past several weeks in regards to conversations with clients. The discussions I've heard about from others at TrustPoint and the conversations that I've had have really been essential for us to have a better understanding of clients' perspectives and how they're viewing these circumstances. Is an important part of what we do, and it's what we're here for. So I want to say thank you to those that have connected to someone at TrustPoint, giving us that opportunity. To your question, what stands out most is how each conversation can be so different. And this might not come as a surprise, but it certainly shows the broad base of reactions to the times we're in. There really is a wide range of perspectives. Some have concerns and want to know what our thoughts are. Some want to know if they need to do something in their portfolios. Several have asked if it's time to buy in and be more aggressive, taking this as an opportunity. And a few have wanted to know if they should sell. And to be honest, some simply want to know how we're holding up in this extraordinary environment. But any of these reactions are really okay. It's very a challenging time, and there's nothing wrong with these. No matter what the frame of mind is, no matter what the perspective is of clients, where they're coming from, we are here to help, and we want to try to provide some clarity. I think this next chart does a nice job to help comfort investors, especially those that are wondering if they should do something. From a survey that was completed just over a week ago by Bankrate, it appears that most investors are taking recent market swings in stride. As you can see here, the largest number of respondents, about 2/3 surveyed, said they intentionally did not do anything to their investments. And 13% on the far left said that they added to their holdings. That leaves about 10% that did change or move money out of investments. And then another roughly 10% that I guess are truly quarantined from all the lines of communication that are going on, and they say they weren't aware of the volatility. I think there's a little bit of hidden message here as well, and that is simply taking no action is making the decision. The urge to do something is real, but the need to do something is not.
So Randy, we all know that it's pretty easy to get caught up to all the headlines and the daily briefings on the virus. Any words of advice you would like to share with those listening regarding the risk involved in allowing our emotions dictate our investment decisions?
Yeah, thanks, Jan. And after the previous chart, I'm not sure that we have to spend a lot of time on this, but unfortunately, it goes without saying that we're not through this yet. The headlines will become challenging. We're all eager to see the days when cases start to decline and, of course, fatalities diminish, but we're not there yet. So, and you never know when the thought of enough's enough is going to creep into investors' minds. So I think this chart helps to remember recoveries have rewarded patient investors. So what you're looking at are the returns on average, after a bear market bottom. On the left is staying invested. After 1, 2, and 3 years, you can see 1 year, about almost 70% return. After 3 years, the cumulative return is over 100. Pretty impressive returns. Now, if an investor happens to miss out on that first month's return, you can see what happens to those returns. The first year almost gets cut in half. And then after 3 years, the cumulative return goes from over 100% down to 60%. You can see how the longer term, if even 3 months of the rebound are missed out in 6 months. So pretty telling on the benefits of staying invested. I guess I'd also argue that the decision to buy back in or re-enter the market is probably a harder or more difficult decision than getting out in the first place. When it comes down to it, the easiest put is you don't want to put yourself in a position where you're rooting against the market to find an entry point. As we move to conclude today's webinar, I wanted to conclude with sharing one more graphic unrelated to the investment markets. You've probably seen the graph that illustrates the benefits of flattening the curve. This graph, it's a little bit different, but there's very clear message of the power of social distancing. So as you can see on the very top of the portion of the graph, current statistics show that there's about an infection rate of 1 to 2.5 people. And when you take that over 5 days and then look at 30 days, that means 406 people are infected. Through social distancing, if we limit that to 50% exposure, so 1 person to 1.25 people infection rate, that means a drastic drop down to 15 infected people in 30 days. And if we can diminish the exposure to 75% of what it has been, that means less than 1-to-1 ratio of infection rate. And that means over 30 days, it only means 2.5 infected people. Pretty powerful. I think this illustrates well why we hear often that we're in this together and we need to do our part. That is all we have for you today. We look forward to the next time. But before we conclude the webinar, on behalf of TrustPoint, I want to thank you for your attention. I want to thank you for working with us. If you have any questions, please don't hesitate to reach out to your contact at TrustPoint. Stay well, be safe, and have a pleasant weekend. Thank you.